Well, good day, everyone. This is David Prouse from Valorum Business Advisory, and today we're going to go over the State of Owner Readiness Report that was released in October of this year, 2021, and it was compiled by the Exit Planning Institute nationally, and they're located around Cleveland, Ohio, and it was also compiled through the efforts of the New York City chapter of EPI. And I think you're going to see, as we go through this report, that there really was a shift in owner composition and readiness, exit readiness from previous reports. And I think it's important for us to take some time to sort of understand maybe what that means to us here in Canada, and specifically in the Toronto area. Don't forget, subscribe to my newsletter, Enterprise Value. I'll leave the link in the description. If you have any questions, reach out to me at value@valorum.ca. And don't forget to visit my website, valueacceleration.ca, where there's lots of resources on value growth, exit planning, and corporate finance topics. Now, let's talk about the state of owner readiness in New York City. So first, what are the state of owner readiness reports? These are reports that have been conducted in the U.S. through the Exit Planning Institute since 2013. The first one was based in Ohio, and there have been numerous reports that have been issued annually since in various different regions of the U.S. Unfortunately, there's not been one conducted in Canada to date. That hopefully maybe that will change in the next few years. There was not a report conducted in 2020 due to the pandemic. So this New York City report is really the first one we've seen since 2019. And the general purpose of the reports is to determine really three different things: the degree of financial, business, and personal readiness of middle market owners to exit their business. Secondly, to ascertain what exit options are most common amongst real owners. And lastly, determining the strengths and weaknesses of owners' exit plans in terms of both planning and execution. So what's the report structure? This report came in three different distinct parts. The first part talked about demographics and what the primary demographic data of owners undertaking the survey were. The second part gave key observations of the owner transition plans and owner readiness. And the last part talked about recommended actions for both owners and advisors. Okay, so let's move on to part one, where we look at demographic data. And specifically, we explore what is the composition of owners who took this survey. So the first thing we'll notice is when we explore the ages of the respondents to the survey, is that 88% of the survey respondents were below the age of 50. And this was markedly different from other EPI surveys where they had been predominantly composed of baby boomers. So a lot of 55 plus, certainly some into their 60s. And so this is very interesting in that we're seeing, there'll be a lot of Gen Xers, maybe even some millennials mixed in. And so what's important to take out of this is, as we explore our way through this report, are there any major differences between what we're seeing from these Gen Xers versus what we've seen in the past from a lot of baby boomers? So next, let's take a look at the size of the businesses in the survey based on their revenue. And we've got three different kind of metrics that you can see on the slide. We've taken a look at the composition of businesses in this particular survey. We've also included as a comparison the composition of all previous EPI surveys. And then just to kind of give some extra context, we've also provided information from the U.S. Census. Keeping in mind this is a U.S. Centric report, and what we can see is, from the 2021 New York City EPI survey, 73% fall within the $5 million to $100 million in revenue range. 22% would be over $100 million, and only 5% would be under $5 million. Okay, so for the purposes of this presentation, the green area would be what I would consider the middle market. Certainly, you could argue the lower middle market. In the U.S., the middle market probably expands a little bit more. So part of that 22% would probably include the upper middle market, but it would go all the way up into public companies. So, and 5% would be under 5 million, and that's basically smaller businesses. In the U.S., that would mostly be considered a Main Street business, although it could be lower middle market. If we compare that to other EPI surveys, we see that 55% of them have been businesses under $5 million in revenue, and 38% would be what we would call the middle market, and 7% would be large companies. And just again, extra context, we look at the U.S. Census, 94% of businesses are actually going to fall into that under $5 million category. Only 6% are going to fall into that middle market category, and then less than 1% are going to be above $100 million in revenues. So that's important because we need to keep this in mind as we go through this report. Obviously, the respondents to the New York City survey, generally speaking, are going to be larger than in previous surveys. And that is going to potentially impact some of the answers we see. But I think it's important for us to figure out, is there something we can take away from that, given that some of these businesses are bigger? Maybe there's some other illuminating factors that we can pull out of them. So the next question in the survey was, how did your current business start? And we can see a little over half started from scratch. About a third received the business from their family, so it's a family transition. A little bit less than 10% purchased the business from their family. And a little bit less than 10%, maybe a little bit larger than that last category, purchased the business from a third party. So in this particular survey, a couple of things. So in previous surveys, the proportion that's come from scratch was well over 70%. We are seeing in this survey a lot more businesses that are family run. And we are also seeing a lot of businesses that are second and third generation, as we'll see. Very few of them really came from or transitioned from a third party. So further to that last point, as you can see in the survey, about 58% were 100% family owned. 22% were family owned, family controlled, but with a mix of some outside ownership, probably as a minority shareholder. 5% were a mix of family and outsiders, with the outsiders in this particular case controlling the business. 12% were completely outside ownership, and a little small proportion were either public companies or not applicable. In this slide, we take a look at the composition of businesses in terms of how many generations are currently involved or have been involved with the business. So obviously for family-owned businesses, that's very important. And we can see that the majority of businesses that were part of the survey were either second generation or 3+ generations. the first generation was actually relatively small, a little bit less than 15%. So that's a very interesting statistic, because we know that family businesses do have a tough time, especially when you get into the third or greater generation. So what's interesting is that, but maybe not so surprising, is that, the New York City area is going to have a lot of long-time family-owned businesses. So it'll be interesting to see how some of the answers as we move along are a little bit different from maybe some of the other surveys we've seen before. So now we're moving on to the second part of the survey. We're going to take a look at some of the key observations. And we noted in part one that the composition of owners was a little bit different. So I would anticipate that some of the observations might be a little bit different from previous surveys too. So let's just take a deeper dive into that and see how that plays out. So first, in terms of transitioning timelines, the question was asked, when are you planning to transition the company? And the majority stated they were going to do that in the next 3 to 5 years. The next largest group was 27%, and that was 1 to 2 years. The third largest group at 21% said they were going to transition the business within 6 to 10 years. And in this survey, only 8% said they had no plans to transition. So this is a little bit different from previous surveys in that the planned time to exit is a lot shorter than in the previous surveys. Most of the owners, so if we combine the 44% and the 27%, we're going to get 71% are going to planning on transitioning their business in the next 5 years. And that is vastly different, certainly from the original surveys back in 2013. And it just shows just a different mindset about exit readiness and a different approach towards it. The next question revolved around transition readiness. The specific question asked was, on the following scale, please rate how ready you are or you consider yourself to transition your business. And this was provided on a scale of 1 to 6. The majority of respondents rated themselves 4, 5, or 6. In fact, quite a large number. I would say about almost 90% said that they were essentially, to some degree, transition ready or more ready than not ready. So that is very different from previous surveys where, again, the owners have generally been unready to transition, or certainly the answer to this question would be not necessarily readily apparent to many of them, because I think for a lot of the owners, they've not put enough thought into it, so they may be ready in some fronts, but not in others. So it's interesting that I think this identifies a certain level of confidence that these owners do feel comfortable that they've put some efforts into exit planning and are on the right path. So the next question asked about whether owners had undergone any formal exit planning education. And as you can see, 81% in this survey said yes, 19% said no. And that is a huge change from the original survey way back when in 2013. And actually, just to take a step even further back, the Exit Planning Institute started in 2007. And at that time, exit planning education was incredibly minimal. And so I think it's good. It's a good sign that the respondents to this survey have undergone some sort of formal exit planning education. And I think the answers in this survey are consistent with that, in the sense that these owners are doing some of the important things that they should be doing from an exit planning perspective. And I think this has come from probably multiple years of formal exit planning education from either their most trusted advisor or perhaps multiple advisors, and they're now executing these plans. They're taking into account what they've actually learned and applying it to their own businesses. Now, as we noted before, most of the respondents in the survey are running family businesses, and exit options tend to fall into one of two categories: internal or external. And as you can see, the internal exit options really tended to dominate this particular survey. And that's not really necessarily surprising when you have a family-run business where, generally speaking, the idea would be to keep passing the business down through the different generations of the family. And so especially if you are on generation 2 or 3 or 4, there's just a certain expectation that the family's going to control the business. So here we see a lot of internal options being explored versus the external options. And the largest one was a transfer of ownership within the family. That shouldn't really surprise us. The second largest one was employee stock option, stock ownership plans, or ESOPs. Now, I should mention, obviously, this is an American survey, so there are some tax advantages in the U.S. to setting up an ESOP that don't necessarily exist in Canada. That doesn't necessarily mean that ESOPs are a bad idea in Canada. You just need to have the right reasons to do it, and you're not necessarily going to have the tax advantages to do it. Some of the other options were management buyouts or buy-ins, and just a small section there really just on sale to existing partners. So this could be a family-owned business where there's multiple partners, maybe 2 external partners, and you end up selling out to the other business partners. Of the external options, not a surprise that third-party exits were considered. And again, that would include both strategic, private equity, and just, non-family individuals. And some of the other smaller options considered would be recapitalization. And recapitalization is when you're not doing a full exit, but you are doing a partial exit, and you may move from either a majority shareholder to a minority shareholder, or you may move from the predominant 100% shareholder to still majority shareholder, but now there's a minority interest involved. And sometimes you will see that with private equity. And then the last option, other than not sure, was orderly liquidation. And orderly liquidations are really going to be your last option that you really want to consider, just because an orderly liquidation is usually going to be probably forced upon you because you don't have a transferable business. So in this slide, one of the questions that was asked was, on a scale of 1 to 6, rate what they believe the emotional impact of stepping away from your business will be. And as we know, especially, for lower middle market businesses or middle market businesses or Main Street businesses, emotions play a large role in the exit. And, what's important to remember here is that, so far we've seen in the survey that the respondents seem probably a little bit more sophisticated than showing up in some of the other surveys. But yet here we see in this particular question, there's an admittance that there is an emotional impact to transitioning the business. So even with more sophisticated owners, perhaps, or owners who are a little bit more educated on the exit planning front, emotion still plays a large role. And it's important to understand that for most owners, in the middle market, undergoing an exit planning program is going to create emotional reactions that aren't always positive. They could be a mixture of fear of the unknown, could be happiness, could be anger. Someone values your business and you don't like the value. There's some anger there. There's a lot of things that play into the exit planning process. And the reality is that those emotions are going to impact, the ability to transition a business. It'll impact perhaps the price that the business ultimately transfers at. So it is important to understand that emotions are going to play a major role. So it's important to not necessarily keep those in check, but be honest with yourself that there is an emotional attachment to that business. And that's part of the problem of what creates some of these exit planning problems in the first place. If we look at private equity is very machine-like about how they handle investments. Well, that is not necessarily the case for the average middle market owner, because they're not professional investors. They're people who have built up a business, and for the most part, they heavily identify themselves with that business. And so that creates an emotional attachment. So that is something that is something that needs to be managed throughout the process if you're going to have a successful exit. The next question dealt with post-exit activity. In other words, what were owners planning on doing once they had transitioned from their business? Now, this is an interesting question given the age of the owners, which was a little bit younger than found in other surveys. So here, the largest answer was invest in another business or serve on a board of another business. And that really isn't too surprising in that, most of these owners are, we've already said that they want to exit. A lot of them want to exit in the next 5 years, tops. A lot of them are going to be exiting in their 50s or late 40s. And so they're not ready to retire. And they probably enjoy entrepreneurship. And so they want to take it to the next level, invest in another business. Or if they don't want to be necessarily, an investor in a specific business, maybe they want to play an advisory role, which is, again, something that could be very useful. They could help other owners in their own exit transitions by being either, part of an advisory board or a fiduciary board, etc. The next largest response was philanthropy. That tends to be something that we see a lot, especially for well-off owners. Once they are transitioning, they're going to have, depending on their situation, maybe more money than they even need into retirement. So, the question is what to do with it. Now, obviously, there's other, family considerations, but assuming, the owners feel that family is taken care of, philanthropy is a good cause, and of course there's a lot of interesting tax planning around that. But for the most part, it gives owners something worthy to do after the retirement. Now, coming in third in terms of responses was become a consultant or buy another business, and the other option, become a consultant. Again, kind of similar to serving on a board, but being a consultant would be a different relationship than being a board member. Certainly, if you were a fiduciary board member, that's a very serious kind of role. Something like being a consultant could fill the needs of many owners who, aren't ready to just golf or travel full time, and they want to keep their brain sharp, and they want to transfer some of the knowledge that they've gained over the years to younger owners. That's something that's certainly an option. And we see 32% said they just wanted to retire. Even within retirement, I think there's a lot of, okay, but what do you want to do? So there's still a lot of deeper diving that has to happen there, but certainly from a broad perspective, retirement's an option. And only 4% said they had no plans. So again, I think compared to other surveys, we see owners who are more interested in certainly being actively involved after the transition in some capacity, and it could be certainly, rolling up the sleeves and becoming, an investor, and it could be a minority or majority interest in a business, or playing a role of like an advisory board or a consultant, And then some of the other options dealing with, philanthropy, retirement, etc. Those are all things that you could take deeper dives into specifically what they're going to do, and they should be taking those deeper dives because those are pretty broad categories. In terms of lifestyle changes, the answer to the question that was posed was interesting in that 47% said that the company will have to continue to perform well for me to maintain my lifestyle. Now, that in itself isn't unusual. I think that's true for many business owners. But given what we know about the survey, where a lot of owners are considering a family transition, and the one thing I will say about internal transitions or family transitions is that you are not doing, generally speaking, a full 100% exit. It's generally going to be a phased exit. And because it is a phased exit, you need the company to do well while you're in that transition phase, which could last, who knows, anywhere between, 1 year to 10 years. Just depends on what your goals are. So it's important that these owners, if they're transitioning, they need the next group, whether it's management or their children or, outside management, they need them to be successful at, not only maintaining the business, but growing it. So I think that's interesting. Now, the other side of the coin is that 44% said their lifestyle will not change regardless of what happens to the company. And that's sort of a nice luxury to have. 7% said they plan on reducing their lifestyle. I think the results there are sort of interesting, and it's something to keep in mind. So one of the more interesting questions that was asked in this particular survey was, what does your written plan encompass? So I'm just going to walk through the different answers, first of all, and just kind of explain why each of these is important, and then talk about what's interesting about some of these, the ranking of some of these based on the respondents to the survey. So first of all, goals and objectives are very important towards any sort of exit planning or growing your business, because you have to have a roadmap in mind, and you need to know where you're going and then kind of work your way back. So whenever we get involved with a client and we're engaging in a value acceleration program, goals and objectives are incredibly important, because one of the things that we need to do is figure out where we are now, where we want to be, and then how are we going to get there. This is really the three things that are important. So goals and objectives are, where do we want to go? Personal financial plan is important, because I always talk about the three legs of the stool. And the three legs of the stool is business readiness, personal readiness, and financial readiness. So personal financial plan is really addressing the financial readiness part of the equation, because you need to know how much you need to retire upon to meet your lifestyle needs. And then you need to correlate that with your business valuation and do some tax planning and figure out, well, what are your net proceeds going to be after everything's all said and done, etc., etc. So all of it's interrelated. So contingency planning is important because we've talked many times over about the 5 Ds, right? There's death, distress, divorce, dispute, and disability. So anything could, if you're running in a business where you have multiple partners, or even if it's just a family business and something unforeseen happens, you need a contingency plan. And a buy-sell agreement is a very large part of that. And you'd be surprised how many businesses don't have one. So establish transition advisory team. So this is important, something that's often overlooked, is because for a lot of businesses, they don't have an advisory team. It's unfortunate because for a lot of owners, they may not even have a trusted advisor, or they may have trusted advisors, but there's no unified message coming from them. the accountant saying one thing, the lawyer saying another, the financial advisor saying something else. Nobody's really on the same page. Business valuation is important, as I just mentioned again. The financial readiness. Well, the business valuation part is important because it really gets into business readiness. To what degree can your business transfer, and what are the key drivers of your business? It's important because you can't just assume that your business is transferable. And there's a range of values that even if a business is transferable, there's a range of values that any business can sell for depending on a number of factors. Because a prospective investor is going to look at that business and it's going to look at the fundamentals, it's going to look at the risk of the business, the risk of achieving those cash flows, etc. So strategic analysis and value enhancement plan. So once you understand your business valuation, or get a little bit more educated about what goes into it and what your value drivers are, now what you need to do is start attacking those value drivers and come up with a strategic plan to help improve the value of the business. And ideally what we're trying to do there is increase the cash flow, increase the growth rate, and de-risk the business. So evaluation of all transition options. So again, we've talked about, we looked at just one of the slides, a few slides ago, we looked at internal exit options, we looked at external exit options. Each of them has pros and cons. So it depends on what's the criteria for any given owner, what do they value the most? And there's always probably some compromise. For example, selling to a third party is probably going to maximize your proceeds, but there's probably a lot of qualitative factors that may not be addressed through a third party sale. For example, the purchasers, may have no interest in keeping on staff. They may take that business and move it elsewhere, and that may not align with your values, etc., etc. Tax planning is important because we need to have we want to maximize not only the business valuation, but we also want to maximize the net proceeds after everything's all said and done. So that's where tax planning comes in. Estate planning is important because estate planning is part of really, the overall holistic wealth of a particular individual. So proper estate planning is just going to make sure that something happens to the business owner or a shareholder, that there's a contingency plan in place, that there's proper insurance in place to avoid what could be something catastrophic for a business and maybe even causing it to liquidate the company. Detailed action plans are important because, for example, we talked, one of the items above was the value enhancement plan. Well, the detailed action plan is really aligned with, what our goals are. It's aligned with, all the things that we need to do, like, for example, our tax planning or estate planning, the enhancement planning, etc. So what you're looking at is like, what are our goals? What are we trying to accomplish? And then working our way backwards to address those things. And you can't do a million things at once. If you try to juggle 20 balls in the air at once, you're going to drop probably all 20. So what's interesting about this particular slide as well is obviously goals and objectives were very high. So I think that boils down to, again, the owners are younger, have probably had some education on exit planning, which we noted before. And the owners are younger, so they're kind of bought into the whole concept of exit planning. And I think the whole, goal setting and objectives is something that's a little bit more common for, some of the younger generations, the non-baby boomer generations. So that's a good thing. But what's interesting is detailed action plan is something that was pretty much one of the lowest categories. And it just goes to show you that when you can have goals and objectives, but without that detailed action plan, this is something that's going to, it's room for improvement for the respondents of this particular survey. So that's something that they would have to work on. Probably, again, if they have an exit planning advisor helping them or a transition team, this is something that really is what they're there for, is to help the owner address those specific things. A couple other things, a little bit surprising, was the low results for tax planning and estate planning. And tax planning, there's a lot of work that goes into sort of, trying to figure out how a particular deal is going to be structured. And again, whether it's internal or external, it's going to have a big role. If it's external, you got to think about, is this probably going to be structured as an asset sale, or is it going to be a share sale? So there's a lot of work there. And, one of again, this is a US-centric report, but I'm just going to give you the Canadian flavor. Some of the tax restructuring that usually needs to be done on the Canadian side has to be done way ahead of time. So please keep that in mind, that tax planning is something that you need to think of at least 2 years ahead of time. So if you do have a corporate structure where you have, let's say, holding companies, for example, you may be in a situation where you may not be currently able to take advantage of the lifetime capital gains exemption, but you may want to. So these are things that really should be addressed ahead of time to kind of position the company to take advantage of them without crossing any particular lines with the tax department. So on this slide, the question was asked, how comfortable are you that your managerial team will be successful? And as you can see, 66% said they were uncomfortable at the present time. 8% said they had some concerns about the ability of the team. So, in total, that's 74% were generally had a bit of concern about whether their current management team could really, rise to the occasion if there was a transition. So that's about 3/4. 24% said they were very comfortable, so about a quarter, and then only 2% said they haven't thought about it. So it's good that only a small percentage haven't thought about it. But what's interesting is that 3/4 are essentially saying they have some concerns, and yet earlier on we saw that that many of these owners felt that they were sort of exit ready or transition ready. One of the things that's really important, and again, whether you're going to do an internal transfer or an external transfer, the ability of the management team to run the company is very important, because it really boils down to whether the owner is involved with the business or not. How transferable is the business? And that is something that a prospective purchaser is going to look at, because they're not necessarily going to be interested in having the owner stay on. They may or may not be. The owner who's selling may or may not be interested in staying on. Some of them will be. We know in this particular group, we know that they have expressed the notion that more of them may be willing to stay on. So this is something that's really critical to the transferability of the company. So this really just indicates that there's still some work to do, even though this particular group seems to be very educated and has certainly made some progress on developing written plans. But at the same point in time, they've still got some work to do in terms of the actual execution. So we mentioned before about some businesses having an advisory board. There's really two different types of boards. There's an advisory board and there's a fiduciary board. And the composition of either may be different. And 91% said yes, only 9% said no. And then this question is kind of part two, but do you have outside board members on your board? And 70% said yes and very active. 17% said yes and somewhat active. 13% said no. So presumably the no probably could be maybe family, presumably, family or friends. So that's good, because basically what we're saying is 87% of these businesses in this particular survey have outside board members, and there's some degree of activity there. And that's important, because having an advisory board or having a board of directors, especially if you're getting near transition, is important, because having outside points of view is critical to give you a different perspective. I think those boards can play multiple roles in terms of providing strategy, providing accountability, and also just a different point of view. So the last question that was asked in the survey was, who do you see as your most trusted advisor? And in previous reports, predominantly the CPA or the lawyer tended to be the most dominant trusted advisor. In this particular survey, it was very different in that the financial advisor came in and it wasn't even close. It was a very dominant 55% compared to the other categories. We see 10% for lawyer, 9% for accountant, 10% for the commercial banker, and 12% for the spouse. So I think it's interesting that the financial advisor came in so high, but I think that's good in a way because the financial advisor is the one who, the professional who has a holistic view of the person's entire wealth. And obviously the transition of that business and harvesting that, trying to turn that into, money for the particular business owner is a critical part of their role. And I think, when you think about how the value acceleration methodology works, we talked about the three legs of the stool. And of course, I just mentioned the financial financial readiness was really important. So, and I think, again, we know this group is particularly a little bit more educated on exit planning than the past. So maybe it's, not so surprising that the wealth managers have such a dominant role in probably helping to drive the owners into succession planning, exit planning, etc. The other thing that probably also makes sense is that this particular group in the New York City survey is very heavily skewed towards family businesses. And we also know that many of these are second, third generation family businesses. So again, probably not too surprising that a multi-generation family business would have a financial advisor or wealth manager being perhaps their most trusted advisor. So I think that's probably a good sign that we're seeing something like this, and probably indicative of also the education that these owners have received. A couple things are a little bit surprising. The lowest group here was the peer group, and I think I just want to mention I think it's really important that we recognize that the peer group is a potential source of advice because everyone within that industry, even if they're competitors, they kind of have a vested interest in succeeding because if one business transitions successfully and gets a good valuation, that's going to probably have a spillover effect to other businesses that happen to be certainly within this particular geographic area. And just in general, peer groups can be a great source of both support and information for the business owners in their transition. So what are some key takeaways for owners and advisors? The 2021 State of Owner Readiness Survey conducted in the New York City area illuminated a few key differences between previous surveys. Some of these differences may be more geographical in nature, that is, traits more specific to the New York City area businesses, but also may be indicative of shifts in owner intentions as education around exit planning becomes more commonplace amongst both baby boomer and Gen X owners. Overall, some of the key differences from previous reports can be summarized as follows. In general, owners were younger and more representative of Gen X owners versus being baby boomers. Owners were more likely to have engaged in some form of written exit plans, including personal, business, and financial readiness plans. Owners were more likely to have been second or third generation owners rather than founders. And in general, more owners were comfortable embracing business valuation and value creation than in previous surveys. Financial planners and wealth advisors were considered amongst the majority as their key trusted advisor, while surprisingly CPAs and lawyers scored much lower than found in other surveys. Despite the overall greater awareness of exit planning issues amongst owners, there were still some areas for improvement. Notably, areas of weakness included tax planning, estate planning, and developing a written, detailed action plan. The latter is important because it provides the engine to realize the goals and objectives the owner has previously laid out. Overall, the New York City State of Owner Readiness Report was illuminating from how it differed from previous surveys. In general, businesses were larger and more family-run. In terms of education, more owners had undergone some form of exit planning education, and this was put into practice through the use of various types of written plans, including goal setting, value enhancement, and personal readiness. The Wealth Manager Financial Planner was voted as the most trusted advisor, which indicates that, at least in New York City, CPAs, lawyers, and other professionals should focus more efforts on understanding their client businesses and deepening their client relationships. Lastly, there's always room for improvement, and even amongst this particular group of owners, things such as tax planning, estate planning, and creating a detailed action plan are areas where more effort are required. As always, exit planning is a complex affair, but it starts first with owner education, then owner commitment, and finally, through owner-committed action. So start the conversation today and give us a call or book an appointment.